Good morning. If you want to go ahead and make your way to your seat, we'll kick things off. Good morning and welcome. I'm Stephanie Kyneth. I'm the Vice President of Strategic Initiatives for the Dayton Area Chamber of Commerce. And welcome to our final Government Affairs Breakfast of the year. Thank you so much. So many familiar faces, but we are thrilled to welcome Dr. Loretta Mester back to Dayton. She was last here, a little over 5 years ago, and not much has happened in the last 5 years, so I don't know what we're going to talk about today, but really excited to welcome her back. Always a really engaging and informative speaker. But first, to kick things off and to thank our sponsor and welcome our incoming board chair, we have Chris Kirshner, who is President and CEO of the Dayton Chamber.
Good morning. Thank you, Stephanie, for the nice introduction. Thank you to Amanda Bergman on our team for putting this together today. Also, a very special thank you to AES Ohio. AES Ohio has been a longtime sponsor of our Government Affairs Breakfast. And they do it because they want to support the business community and they want to support the chamber. But this wouldn't be possible without their continued support. So thank you to AES Ohio. Their president and CEO, Christina Lund, is on our board at the Dayton Area Chamber of Commerce. And their vice president, Tom Rega, has been very involved with our legislative and economic development efforts at the chamber. So thank you to both of them, and thank you to AES Ohio's commitment to the region. I also want to welcome all of our national news media outlets. Thank you for joining us. If you all see the camera in the back, that is being live streamed, being picked up by a number of national news outlets that are joining us today. They seem to be really interested in what I'm here to say and maybe a little bit what Dr. Mester wants to say. But no, we're glad to have them here. Welcome to Dayton, Ohio, even if it's virtual. It's great to have you here. If you're ever looking for positive news stories on business growth, we're the place to look. So Dayton is doing great things, and we're excited to have you join us today virtually on the live stream. The Federal Reserve Bank of Cleveland has a business advisory board in this area. This is a board made up of local chamber members, local businesses that help educate the Federal Reserve on the local economic conditions, and we get regular information from the Federal Reserve on monetary policy and where things are heading on a national economy. I serve on this business advisory board. There's about 15 others in this area that also serve on this business advisory board with me. There's somebody that used to serve on this business advisory board with me. I walked into one of our meetings, we host them at our chamber office, and we were missing one person, and her name is Jackie Gamblin. And when I asked why Jackie wasn't at the meeting, I was told she got called up to the big leagues. Jackie was asked to serve on the board of directors for the Cleveland Federal Reserve Bank and be that voice of this region and the voice of small business for the Federal Reserve. So it is quite an honor to have somebody who is a local business owner, who is the incoming board chair of the Dayton Area Chamber of Commerce, and somebody who knows our business community better than anyone else, and Jackie Gamblin representing our voice to the Federal Reserve. So I now want to introduce the founder and CEO of JYG Innovations, Jackie Gamblin, so that she can introduce our keynote speaker today. Jackie.
Thank you, Chris. Appreciate the great introduction. It's my pleasure this morning to introduce you to Dr. Loretta Mester, our 11th President, Chief Executive Officer for the Federal Reserve Bank of Cleveland. She is responsible for participating in the formulation of monetary policy. She oversees over 1,000 employees in Cincinnati, Cleveland, and Pittsburgh, whose responsibilities include conducting economic research, supervising banking institutions, and also providing payment services for commercial banks and the U.S. government. Dr. Mester also has several civic engagements. She is the trustee for the Cleveland Clinic, for the Cleveland Orchestra, and also serves as a director for the Greater Cleveland Partnership and the Council for Economic Education. It's been a pleasure working with her. She is a collaborator. She is a great listener. And I think you're going to enjoy her comments because she always has very thoughtful comments to share. So without further ado, Dr. Mester.
Well, good morning, everyone, and it really is a great pleasure to be here, and I really am looking forward to the Q&A part of today's session to hear what's on your mind. I want to thank Jackie to start with, first for the kind introduction, but also, as you heard, Jackie is not only the CEO of JYG Innovations, Jackie's also director of our bank, the Federal Reserve Bank of Cleveland. And I really want to thank her for that public service to our organization and to the country, because by serving on our board, you're actually doing public service for the country. So our directors, and Jackie in particular, they really provide us with a wealth of economic information that really helps inform us about how households and businesses are doing in the economy. And that's really important for the formulation of monetary policy. This regional information that we're getting throughout our 4th district really helps to inform how we go about deciding where interest rates should be so that we can keep the country on a good path. And if you think back to the unprecedented environment that we've all had to deal with over the past couple of years, I really can't overstate how important getting that real context and information has been to the formulation of policy. And I want to thank Jackie for that. And I also want to thank all of you in the room because, as you heard, a lot of you are providing information to the Federal Reserve Bank of Cleveland. And that really does inform our work in the Fed, whether it be the work that we're doing on monetary policy, but also our community development work that we're heavily engaged in the district. So thank you for that. So the last time I spoke at the breakfast, and you heard it was a while ago, a lot has transpired in the economy. Okay, so at that time, the economy was in the 9th year of an expansion. Labor markets were strong. The inflation was finally moving up to our 2% goal after running below the goal for some time. And the Fed was continuing to increase its policy rate, the Fed funds rate, to be consistent with those healthy economic conditions and the outlook. The economic expansion continued for another 2 years until the pandemic changed all that. Now, the resilience shown by households and businesses over the past 2 challenging years has, I think, been truly remarkable. But many challenges remain, as you well know. In particular, inflation, which is at a 40-year high, is a serious burden for households, businesses, and the overall economy. So today I thought I would focus my remarks on how monetary policy will foster a return to price stability. And of course, the views I present will be my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So the key challenge facing our economy is unacceptably high inflation. Inflation has been running well above 2% for over a year now. It is very high, not only in the U.S., but also in other advanced economies across the globe. And this inflation stems from many factors, but fundamentally, it reflects an imbalance between strong demand and constrained supply, which has led to significant upward pressure on prices. Now, various surveys and my conversations with regional contacts reveal that inflation is the #1 concern of businesses and households. And it imposes a particularly onerous burden on those who don't have the wherewithal to pay more for essentials like food, gasoline, and shelter, which happen to have the highest inflation rates among other sectors. So price stability is the foundation of a strong economy. It's necessary for ensuring the U.S. can sustain healthy labor markets conditions over the medium and longer run, and that the economy can be productive and live up to its potential for everyone's benefit. The FOMC is committed to using its tools to bring inflation back down to our longer-run goal of 2%. It is taking decisive action to remove monetary policy accommodation to bring demand into better balance with constrained supply, both in product and labor markets. Since March of this year, the FOMC has raised the target range of the Fed funds rate by 2.25 percentage points, and it's begun to reduce the assets the Fed is holding on its balance sheet, which will also reduce accommodation. Now, given current rates of inflation, I believe the Fed has more work to do in order to get inflation under control. And this will entail further rate increases to tighten financial conditions, resulting in an economic transition to below-trend economic growth in nominal output, slower employment growth, and a higher unemployment rate. In fact, we're beginning to see activity slow down from last year's robust pace. In part, this can be attributed to our monetary policy actions and the tightening in overall financial conditions compared to a year ago. But it also reflects households' and businesses' responses to very high inflation and their concerns about the economic outlook, as well as the waning effects of the pandemic fiscal stimulus and slower growth abroad. Consumer spending, housing activity, and business investment have decelerated from the robust pace seen last year. Indeed, real GDP moved down in the first half of this year. Now, in the first quarter, the main contributors to the decline in output were declines in net exports and government spending and slower inventory investment. But consumer and business spending remained solid in the first quarter. The second quarter saw slower growth in these components as well. Now, manufacturing surveys suggest activity is moderated, but firms in our region are telling us that their strong order books should keep them busy at least through the end of the year. In response to higher mortgage rates, residential investment, which is one of the most interest rate sensitive sectors of the economy, also fell quite sharply in the second quarter. Yet, because the supply of housing has not kept up with demand, housing prices and rents remain elevated. Indeed, supply constraints have posed a significant challenge across a variety of sectors since the economy reopened after the pandemic shutdowns. In product markets, firms have had to deal with a cascading set of disruptions to their global supply chains. And these disruptions stem from pandemic-related shutdowns across the globe, as well as the war in Ukraine, which has further constrained supplies in energy, metals, and agricultural commodity markets. Now, firms in Dayton and other parts of our region tell us that the supply challenges have lasted longer than they expected them to, and they've had to be very creative in meeting those challenges. Some manufacturers are stockpiling large volumes of materials to have them on hand to meet future demand or to fill their backlogged orders. Other firms are custom making parts to substitute for those that are unavailable. And many have been trying to adjust their inventories to be better prepared to meet current and future demand, which helps to explain some of the overstocking at the end of last year, followed by slower inventory building this year. Many firms tell us that they are investing and will continue to invest to make their supply chains more resilient to be better prepared for the future. Now, analysts often use the rule of thumb of 2 consecutive quarters of negative real GDP growth, meaning that the economy is in recession. I do not believe the U.S. economy is currently in a recession because the labor market remains very strong. I do acknowledge that the risk of recession over the next year or two have moved up because financial conditions are tightening globally, inflation remains at high levels in many countries, and the devastating war in Ukraine adds considerable uncertainty and downside risks to the growth outlook, especially in Europe. That said, at this point, I have not incorporated a recession into my baseline outlook for the U.S., but instead I expect a fairly sharp slowing in activity, especially when compared to the robust growth the U.S. experienced in 2021. Now, while there's considerable uncertainty, I currently expect that the U.S. economy will return to positive growth in the second half of the year, but for this year as a whole and for next year, I expect growth to be well below 2%, which is my estimate of trend growth. Now, with the economy growing below trend, I expect the current very strong labor market conditions to cool, with the unemployment rate rising somewhat above 2% by the end of next year. Now, some cooling off in the labor market will put it on a more sustainable footing compared to the unsustainably tight conditions that exist today. Now, the economy added 6.7 million jobs last year, an average of over 550,000 jobs per month, which is a very robust pace. There are widespread reports from a broad spectrum of firms about how hard it's been to find workers. Even so, employment growth has remained very strong this year. Job gains averaged about 460,000 per month over the first half of the year, and they accelerated in July. We're going to get another employment report on Friday, and we'll see what that tells us. The unemployment rate fell to 3.5% in July, matching the lowest level reached during the long pre-pandemic expansion. And although the number of job openings has eased in recent months, they remain at historically high levels. So there are now close to about 2 openings per unemployed worker. And if you think back to 2019, which was another period of very strong labor market and tight labor market conditions, there were about 1.2 openings per unemployed worker. Now, a variety of reasons that contributed to people leaving the workforce early in the pandemic and then only slowly returning to the workforce. These include responsibilities for caring for children or other family members, fear of the virus, reevaluation of their careers, and retirement. And of course, reducing immigration has also constrained labor supply. So the participation rate of prime age workers has returned to where one would expect it to be. But overall participation, which includes those of retirement age, it also includes me, and I don't feel like I'm at retirement age, but I'll set that aside for now. That overall participation rate has improved, but only gradually. Now, typically, most people don't return to the job market after they've retired. So there's really little reason to think that we're going to see an influx of workers large enough to return the overall participation rate to its pre-pandemic level. So firms have been using a variety of ways to attract and retain staff. They've been offering more flexible work schedules. I'm sure you're all doing these things. The signing and retention bonuses, expanded benefits, and higher base wages. And those wage pressures have been building up for a while now and show little sign of abating. The employment cost index for private industry workers accelerated over the 6 months ending in June, rising at a 6% annual pace. And even so, those wage increases haven't kept up with inflation, so workers' purchasing power is being eroded. Now, higher wages that reflect higher productivity growth don't contribute to inflation, and they're a positive for both the workers and the firms. But current wage increases are not consistent with inflation returning to our 2% goal. If you think that trend productivity growth, which is estimated to be around 1.25% to 1.5%, you need wage growth to moderate to around 3.25% to 3.5% to be consistent with price stability. And as former Fed Chair Paul Volcker pointed out in the midst of his fight against very high inflation in 1981, wage gains, when they're not grounded in real growth and productivity, are a kind of economic shell game in which rising incomes disappear at the supermarket or the shoe store. So as their costs have been continuing to rise, businesses have been raising the prices that they charge their customers, and they haven't been finding much resistance. Over the past year, price pressures have broadened across goods and services, and despite some moderation in economic activity, inflation readings continue to be at the highest levels in 40 years. Now, to assess the inflation situation, I look at a variety of different measures of inflation. So we at the Fed have set the inflation target, the 2% target, in terms of PCE inflation. So measured year over year, PCE inflation came in at about 6.25% in July. CPI inflation was 8.5%. And, you know, these readings were down slightly from the June readings, but they mainly reflect a sharp drop in the price of gasoline and energy prices. So that was welcome news, but we really have to guard against wishful thinking becoming a substitute for compelling evidence. And in my view, it's far too soon to conclude that inflation has peaked, let alone that it's on a sustainable downward path to 2%. So first, measures of the underlying inflation trend didn't uniformly decline in July. Only the core PCE inflation rate, which excludes food and energy, declined. If you look at measuring year-over-year changes, core CPI inflation and the median and trim mean inflation rates, which exclude the components that have extreme movements, were either stable or actually increased in July. Second, in the coming months, goods inflation may slow in response to easing demand and the appreciation of the dollar, but the prices of energy and other commodities are set in global markets. And developments related to the ongoing war in Ukraine may lead to higher prices later this year. Third, inflation in the prices of services tends to be more persistent. Services inflation is at its highest level since the early 1990s, and growth in housing rent, and shelter costs, which represent a large share of measured inflation, will likely keep inflation elevated for some time. So all of this suggests that it's going to take a while for inflation to reach the Fed's goal of 2%. I expect inflation to move down this year into a range of 5 to 6%, and then to make more progress towards our goal over the next 2 years. But it will require further action on the part of the Fed to make that so. So in making its monetary policy decisions, the FOMC is always guided by its strong commitment to achieving its congressionally mandated goals of price stability and maximum employment. Now, monetary policy can't affect the supply side factors that have contributed to the very high inflation readings. Instead, it works on the demand side of the economy. So the Fed is being resolute and intentional in tightening financial conditions to bring demand into better balance with supply to alleviate price pressures. Since March, we've raised the target range of the Fed funds rate a cumulative 2.25 percentage points, and the financial conditions are tighter than they were at the end of last year. And in addition, in June, we began to reduce the size of our balance sheet according to the plan announced in May. So reducing the amount of the Fed's security holdings will help to lessen downward pressure on longer-term interest rates by returning some duration to the market. And the reduction in our balance sheet is being done primarily by adjusting how much we reinvest of the principal payments we receive on our assets. Without any asset sales, that process could take 3 years or so. So that's running as we speak now and as we're increasing our interest rates. Now, monetary policy acts with a lag on the economy. So even though other financial conditions like mortgage rates have adjusted, it's likely we have not yet seen the full effect of the rate increases we've implemented so far on households and businesses. So given the lagged effects of monetary policy, it would not be appropriate to continue moving rates up until inflation is back down to 2%. It's always, as is always the case, we're going to need to be calibrating our policy based on the implications of incoming information for the economic outlook and on the progress towards our monetary policy goals. That said, at our last meeting, the FOMC indicated that it anticipates that ongoing rate increases in the Fed funds rate will be appropriate. And I certainly agree with that view. Given the current level of inflation and the economic outlook, I anticipate that policy will need to move into a restrictive stance in order to put inflation on a sustained downward trajectory to 2%. In my view, that means that short-term interest rates adjusted for expected inflation, that is, real interest rates, will need to move into positive territory and remain there for some time. So right now, nominal short-term interest rates are lower than expected inflation. So short-term real interest rates are still negative, and monetary policy is still accommodative. The current level of the Fed funds rate is near the range of estimates of its longer-run nominal level. And when inflation is at 2%, and inflation expectations are consistent with 2% inflation, this longer-run level would be neutral in the sense of neither stimulating nor restraining economic activity. But in the current high inflation environment, a 2.5% nominal funds rate is still accommodative. and the Fed has more work to do. My current view is that it will be necessary to move the Fed funds rate up to somewhat above 4% by early next year and hold it there. I do not anticipate the Fed cutting the Fed funds rate target next year. But let me emphasize that this is based on my current reading of the economy and outlook. While it's clear that the Fed funds rate needs to move up from its current level, the size of rate increases at any particular FOMC meeting and the peak Fed funds rate will depend on the inflation outlook, which depends on the assessment of how rapidly aggregate demand and supply are coming back into better balance and price pressures are being reduced. Now, making that assessment will remain challenging because there's a high level of uncertainty surrounding the outlook for the global economy, with a variety of forces affecting the demand and the supply sides of the economy. The war in Ukraine and the energy situation in Europe could impose further costs on the people in that region and on the global economy, posing downside risks to growth, but upside risks to inflation. A souring consumer and business sentiment and reactions to elevated inflation readings could result in a larger than anticipated moderation in activity. On the other hand, there are some potential positives on the supply side of the economy. The newly passed fiscal package may have a larger effect on productivity growth and inflation over the near term than current private sector estimates suggest. And with some luck, supply chain disruptions will abate faster than anticipated, and labor market participation will continue to rise, helping to ease supply constraints in product and labor markets and bringing supply into better balance with demand. But we cannot rely on luck. It would be a mistake to declare victory over the inflation beast too soon. Doing so would put us back in the stop-and-go monetary policy world of the 1970s, which was very costly to households and businesses. In assessing the appropriate stance of policy, I'll be looking for compelling evidence that inflation is on a sustainable downward trajectory to our 2% goal. And before I conclude that inflation has peaked, I'll need to see several months of declines in the month-over-month readings of inflation. I will also be carefully watching measures of inflation expectations, particularly expectations of inflation over the medium and longer term. So currently, consumers and businesses expect inflation to be well above 2% over the next year. While recent readings of medium and longer term expectations have eased off a bit, they have moved up over time, and they're at the upper end of a range of values consistent with our inflation goal. Research indicates that changes in the prices of particular salient items, including gasoline and food, can have an outside effect on households' inflation expectations. Now, gas prices have come down from recent highs, but with the uncertainty surrounding world oil supply, gasoline prices could rise again and food prices might remain high. So we need to be particularly attuned to inflation expectations. If longer-term inflation expectations were to become unanchored and move above levels consistent with our longer-run inflation goal, high inflation could become embedded in the economy, affecting the actions of both firms and consumers. At that point, it would be considerably more difficult and more costly to bring inflation down. So a risk management approach suggests strongly against policymakers being complacent about a rise in longer-term expectation. Instead, better economic outcomes are achieved if policymakers assume rises in inflation and inflation expectations are persistent and act forcibly to bring both down. It's good to remember that inflation expectations are determined not only by movements in actual inflation, but also by policymakers' actions to follow through on their strongly stated commitment to price stability, thereby justifying the public's belief in our commitment. So the return to price stability will take some time and a lot of fortitude. There are going to be bumps along the road. Financial markets could well remain volatile as financial conditions tighten further. Growth could slow more than expected. And the unemployment rate can move above estimates of its longer run level. This will be painful in the near term, but so is high inflation. High inflation imposes costs on households and businesses in both the short and the long run. It eats into savings, and it makes it hard to plan for the future. If we fail to take the actions needed to get inflation down and firmly anchor inflation expectations, we won't be able to sustain healthy labor markets over the medium and longer run to the detriment of the public. As Paul Volcker said as he fought inflation in the 1980s, quote, "Failure to carry through now in the fight on inflation will only make any subsequent effort more difficult at much greater risk to the economy," end quote. That statement is as true now as it was then. This is why I remain resolute in setting monetary policy to return the economy to price stability, which is the foundation for sustaining maximum employment and a healthy, productive economy over time. So that ends my prepared remarks, and I'm really looking forward to the Q&A portion of this. And I would ask that, if you're going to ask the question, that's great, but I'd also like a piece of economic information of what you're seeing in your businesses and the region that'll help us set our monetary policy. So thank you very much.
Great. Thank you, Dr. Mester. So while you're thinking about your questions, I know we have some good time. I have a few questions I'm going to kick things off with. So first, for businesses that may be looking for support and resources to help them make better decisions in the current climate, can you share a little bit about the economic research arm of the Federal Reserve?
Yeah, that's a great question. So the Fed, as you probably know, there are 12 Federal Reserve banks, and then there's also the Board of Governors in D.C. And we have almost 400 economists throughout the system who are doing economic research, trying to really understand what's going on in the regions of the economy. And that information that we gather from you all informs our policymaking. So I make it a point when I go to FOMC meetings to actually talk about our region. I think it's really important to bring that information to the table because it really helps us understand more about what's happening in businesses and in households in different parts of the country. And while the macroeconomy may be moving in particular ways, it's really made up of this mosaic of what's happening in the region. So that's one of the roles of the economic research arm of the Fed. But we also produce a lot of economic research that we are hoping and we have seen can really inform you all as you're making business decisions. So the Cleveland Fed in particular is we have a Center for Inflation Research, which when we set it up, several years ago when inflation was running well below 2%, people were thinking, well, why are you setting up an inflation research center? And, I think it was sort of really fortuitous that we had set it up when we did, because now we're producing a lot of measures of inflation and really surveying consumers and households on how they're dealing with inflation. And I think that also can help inform businesses about, where they should be thinking about in terms of their pricing. And then we have a lot of work going on at the Cleveland Fed and throughout the system on workforce development, because that has been a very big challenge, as you all know, over the past 2 years. But even before that, in the tight, conditions of labor markets in the long expansion, which was, a good thing to have people get back to work, it also presented some challenges. And how best, especially in low-income areas where people weren't attached to the labor market, how do you get them more attached? So there's longer-term research on that area, as well as the cyclical research that we're doing. And all of this research, we do it for public consumption. So if you go to our website, clevelandfed.org, you'll see all of our offerings, and I would encourage you to go there. We are very proud of the research we do in Cleveland, but we also have links to other research across the Federal Reserve System that hopefully will help inform you and give you some data and analytics can help you make business decisions.
Yeah, I can't recommend it enough. Even for someone who is not an economist, the research that they provide is really helpful and easy to understand. So I encourage you to check it out. So my final question, and I'll start walking around after this, but over 96% of the Dayton Chamber's members are small businesses. Can you share a little bit about what you feel is the importance of small business and entrepreneurship in our current economy?
So I can't emphasize more how important small businesses are, because you all are really the backbone of the economy. And there's a lot of research that's going on that's done in both academia but also at the Fed that shows the important role of small businesses in employment. and employment growth, and how much, new businesses in particular, and which start out as small businesses, of course, are really contributing to sort of the dynamic nature of the economy. And dynamism in the economy is really important. One of the things that was kind of interesting early on in the pandemic, as people had to withdraw from the workforce, is that there was an increase in the number of business formations, small business formations. That said, there's a lot of challenges if you're a small business that's different from the challenges of a large business. And so there's a lot of work that we're doing. At the Cleveland Fed, we're leading the small business survey for the system. And that we compile, and I'm sure many of you participate in that survey, where we really are trying to understand some of the challenges and also the conditions of small businesses in the economy. We're going to be putting out the new survey pretty soon. But if you look at some of that, one of the things that is important for any business is credit, access to credit. So we've done a lot of work on sort of looking at that in particular to make sure that the small businesses do have that access. We cut the data to look at small businesses that are minority-owned businesses versus other businesses, and of course you can see some of the challenges there as well. So there's a lot of research that's going into sort of how can you make small businesses really support them in a way so that they can be that backbone of a vibrant, dynamic economy.
Great, thank you. So any questions or perspectives you want to share? I see firsthand.
Thank you for being here. My name is Charles Gross, and I'm with Creative Image. We're a post-secondary school, and research just came out today that enrollments at the college level, post-secondary, is down significantly, about 7 to 9%. Most of it is coming from parental and student concerns and concern about what's going on with the economy.
Right.
Any information you could give, plus your great communications about how we can defer those fears.
Right.
Thank you.
This is a big issue because it's not only college, but all kinds of education, secondary education is really important for getting people the training they need to be really attached to the workforce. And that's, of course, very important for the overall health of the economy. So, another factor you didn't mention about why enrollments are down are also immigration. So a lot of schools, especially the larger schools, have a very big component of foreign students, and they have not been coming back. Even as the economy is reopened, it's very hard to have them come back. But there's a lot to this question because it's the expense of going to school. It's the realization that college is not necessarily the be-all, end-all of how you get attached to the labor force. There are other kinds of institutions that also can prepare people for the workforce. But on the positive side, I've seen much more engagement from firms and businesses with universities and with other types of education, apprenticeship programs, for example. So I'm the longer run, I'm more hopeful than the statistic that you point out suggests. But I do think the overall point is right, is that we have to do all we can first to prepare people better, prepare our students better for entering college or whatever that post-secondary education will be. And then also supporting them so that they can get through the programs. Because that's another thing, if you looked at some of the recent work, there are people who have entered a lot of these programs, but they can't get through the programs. And that doesn't help anyone, because what ends up happening is they take on a lot of debt, and they don't get the benefit at the end of it because they haven't been able to make it through the programs to actually gain a good job so they can repay the debt. So I think this is a huge issue. I think the country doesn't really have a plan, as well as I would like to see it, to be able to sort of really address this issue. I'm hoping that the fact that now the business community is involved, that we may see more action on this going forward.
Who else has a question?
Good morning. George Dalton, CFD Research. So first, to your point about what we need, so I'm a small research and development company, and we hire mostly engineers and scientists, and finding qualified candidates is very hard. So, but more to your point, so you asked the question, or you mentioned the Inflation Reduction Act, and how that you think that might help. Yeah, looking at what was being greenhouse gases and things like that, can you explain what part of it you think will help?
Well, there are estimates out there, the Wharton budget model estimates in particular, the ones I cite if you actually go to the text of the speech, right, that say that it'll have a small impact on inflation and productivity, but way late in the cycle. So in terms of informing what's happening in the economy right now, I don't think it'll have a major impact on inflation. But, we've got to be open to the fact that estimates are estimates, and maybe it'll have a bigger impact than we think it will. But all the estimates I've seen in the private sector is that at the moment, the current inflation, it won't. It has an impact later on, and it does have some impact on the overall budget deficit, bringing that down somewhat. But again, that's a perspective on current inflation, right? The future, it may have beneficial impacts on both productivity and inflation in the future, but not in the current environment.
Okay, we got a question right here in the middle.
I'm Woody Stroud. A question arising from COVID and the problems which occurred with logistics and just-in-time delivery of inventories presented a lot of shortages for us. And one solution has been suggested is that we need to bring manufacturing back to the United States. Is there a role that the Federal Reserve can play in encouraging the redevelopment of manufacturing in the United States?
Well, I think our role is to do the research that shows really what that would look like and how that would occur. I think the general point is that, and firms, I think, who have experienced these challenges agree and tell us they're doing is there's going to be, I think, investment in resiliency across the board. I think one of the things that we learned in this episode is resiliency matters more than people thought it might have. And this just-in-time inventory thing sounded like a great idea. Wow, we're going to be more nimble, we're going to move. But what we ended up doing is underinvesting in resiliency. And then when a shock hits, and a shock that you wouldn't expect hits, which by nature, shock is something you don't expect, right? Then you're caught out because you're not as nimble about shifting. And so a lot of firms are doing exactly that. And whether it's bringing more on in-house, like bringing it more to the U.S. manufacturing, or whether it's relying on alternative sources for some of what they're getting abroad, right, there is a lot of work that firms are doing to try to reevaluate those supply chains. So some of it will involve, having more sourcing from the U.S., and that's the bringing manufacturing back to the U.S. Some of it will be maybe not putting everything in one basket in one country because things can happen and then you're not as resilient as you would. But I know that firms now are saying they're really investing in that. And that's, I think, a good development. I'm always fearful that people will forget, like in the moment, right, it's like this is what we're focused on. We have to sustain that. And part of it is because, you're trying to run a business, right? These longer-term payoff investments sometimes are undervalued because you're really looking at current conditions. But I think this episode has really gotten people to think differently about how they're managing their companies and how they're not going to be caught out like they were before. And maybe that kind of thinking is going to be helpful for the next whatever occurs that we can't even imagine what it will be at this point. So,
Got another question right here.
Hi, Forrest Elliott with Edward Jones. It seems like the market is kind of anticipating or hoping that we're one and done when it comes to interest rate increases. But kind of based on your comments, it sounds like we're really in for a long fight here, and we really should kind of anticipate at least 2 or 3 interest rate increases. Are we in this for the long fight when it comes to interest rate increases?
This is going to be a long fight. This is not a one and done situation. We've got to continue to raise interest rates. As I said, we're still, in the process of bringing rates up to a more restrictive level. And that's going to take us, my own path has us bringing the nominal funds rate above 4% somewhat by early next year and holding it there. Inflation is very persistent. The underlying inflation rate is still very elevated, unacceptably high. And we're just going to have to be very resolute in making sure that we do what we can with our tools to bring supply, demand into better balance with supply, which remains constrained. So this is a situation where we have to keep moving interest rates up. We'll have to hold them at whatever that terminal level turns out to be the right level, and then we'll have to get inflation moving back down to 2%. But this won't be a quick fight. It's just the nature of the dynamics of inflation that it's just going to take more work on the part of the Fed.
Thank you for coming. I'm a corporate banker, so just to share what I'm seeing, work with companies, 20 million in sales, several hundred million in sales. Everybody's doing well. I see growth pretty much everywhere. What I don't see is companies able to pass along all of their price increases at the gross margin level, such that if I see 10 financial statements, maybe 2 are holding the gross margin level. Most of them are less. I mean, it's evidence of PPP kind of came and went, but the costs kind of stayed and they're growing. So that's what we're seeing is, everybody's doing fine, but they're not able to pass along all the cost increases, and probably that's expected to continue. 2 questions. When the Fed raises federal funds rates, short-term rates go up, dramatically, directly. When you start rolling off $1 trillion of the balance sheet a year, where does that show up in the yield curve? And then my second question is, when Paul Volcker raised rates to double-digit rates, the federal deficit was $400 billion, $500 billion, now it's $30 trillion. When does that start to show up at the federal level? Because 3% is $1 trillion to the deficit. So those are the 2 questions.
Yeah. Well, it'll, the roll-off on the balance sheet is a gradual roll-off, okay? It'll have some impact on the longer end of the curve, because we have some MBS on there that will roll off later. Most of the early roll-off is treasuries, and that's across the yield curve spectrum. So we're going to see that a little bit coming across the spectrum. But my impression is, and from talking to market people and also looking at the balance sheet, is that I don't expect that to have a major impact on the accommodative conditions versus restrictive conditions in the financial markets. What I do expect is that most of the work is going to be done by our raising the funds rate, and then that being sort of proliferated out across other interest rates. In terms of the deficit, again, I think the roll-off of the balance sheet and the tightening of policy, we need to be doing this in order to get inflation back down. So again, this is sort of job one of the Fed, is to get inflation under control. The government, the fiscal authorities, they're the ones who control sort of budget deficits. Our job at the Fed is to do what we can with our tools, interest rate policy, right, to get inflation down. And that's what we're fixated on, is that's what the job is for the Fed. And as we do this, part of the assessment is going to be how strong, when we'll get demand right into better balance with that constrained supply. And of course, supply could be moving around as we do this. So that's why the assessment of where rates are going, right, we can't be that precise about where that terminal rate is at this point. It's going to depend on that. The budget deficit and other factors will influence sort of how monetary policy affects the economy. But our goals are our goals, and that's what we're doing. And we'll set our policy in order to achieve 2% inflation over time.
Okay, we got another question over here.
Good morning. Dave Burrows with the Dayton Development Coalition. We're also the Jobs Ohio Network partner for this region, like Team NEO in Cleveland. So you have, today we have more multi-billion-dollar projects that not just Ohio is looking at, but the whole country. Intel announced they're coming to Columbus. With the CHIPS Act, now they can expand and do the full, it's $100 million over 20, 30 years. We know that there's stress on the labor force, but from an economic standpoint, what do you see those type of projects doing to the local economy and moving forward? Because there's a lot more of those projects in the pipeline.
No, those projects are important for the region. I mean, one of the things that we've learned is that it's not just bring one firm to the region, right? It's what support can be brought to bear to make sure that workers, right, can get to the jobs that are going to be there, that they're trained, that they're well trained for those jobs. So again, these big projects like that can be very important to the region. But one of the things that the research says is that it takes leadership. So it takes, you all to actually make it be a positive in the region. Just attracting one firm and then saying goodbye, great, you're here, doesn't work. It's got to be sort of supported with, people really thinking about, well, where are we going to get the workers from? How are we going to attract them? Is there housing for the workers once they get here? Can they afford to live in the region in which the firm is coming? So, the Intel plant, big announcement, has a potential, right, of really adding, quite a bit of jobs. We've done some analysis on it, and it does have an impact on the region in terms of jobs. But again, in a tight labor market as we're in right now, right, that's going to be a more challenge. However, over the longer run, it's a positive for the region in terms of getting, good jobs, good, well-paying jobs for people, high productive, productivity jobs for our region. So, I mean, those things are in the balance. They're good, but they need support from these other parts of the ecosystem, right? Talent, management, getting the right skill sets, making sure you're training people. But these things can catalyze that, but it takes the community to support it.
Okay, I think we have time for one more question.
Actually, Dave took my question. I am in corporate banking as well, so I was, with all the government spending and that. But I did want to comment one additional thing. Besides, I agree with him on the commercial industrial businesses, but on the healthcare side, I do have healthcare clients continue to really struggle with the staffing cost. So looking for feedback, this is a huge issue. I don't see the end of this. It's a vicious cycle where the 70% of their costs are staffing, give or take. And there's a shortage. It's a tough work environment, even more so coming out of COVID. And the costs just keep going up. And then the government is doing some things through CMS, increasing the rates, but they can't keep up with the staffing costs either. So you're probably well aware of this, but I just wanted to highlight that because this is not going to end anytime soon from where I am positioned.
Well, I've heard this from the hospital systems that I talk to quite a bit. And one of them even said it's actually a more challenging situation than COVID was in the beginning of the pandemic, which was a shocking comment to me, given how we know how challenging it was for hospitals at the beginning of COVID. So, take that very seriously. Some of the things that are going on, and I'm sure in your system as well, is, really reevaluating what we use different particular levels of jobs to do, like nursing staff. There's a whole reevaluation of we shouldn't be using them for certain things. We can sort of, make the job match the skill sets better. But it's a huge challenge, and that's part of the, when you think about what the Fed's trying to do with our monetary policy. Obviously, we can't affect the nursing shortage or skills shortage, but what we can do is try to cool off some of the excesses in both the product side of the economy and also the labor market to get these things better in balance. You're exactly right. There's this lack of balance now in labor markets, not only in healthcare but across. And some of it is longer run trends, but some of it's the cyclical just nature of what's happening in the economy right now. And that's what we're trying to do, is to get demand into better balance with supply so that some of this pressure is alleviated.
Okay, if it's a quick one, we got time for one more.
Thank you for being here. My name is Mustafa Muna. Actually, my question, two questions, if I can. First one is last year, and since the pandemic started, we got a lot of fiscal spending. We got the CARES Act. We got $5 trillion of spending. So would you guys say that you may need the help of the fiscal side to get inflation down? Because there is a paper out of Jackson Hole that from some academics, and I think from you guys at Cleveland Fed, that says that 60% of the inflation we have now is from the fiscal side, not from the monetary quantitative easing that you guys were doing. would the Fed be able to get it down, get the inflation down without the help of the fiscal side being more contractionary, not spending more, like the Inflation Reduction Act that we just passed? And my second question is, last year, it was the Fed was saying it's transitory, and 12 months later, it's obviously you guys are as hawkish as you can be. Would you say that inflation is coming down because of, say, there is inventory discounting, there is the gasoline prices going down? That actually goes into a lot of inputs in the economy, and maybe actually inflation can work its way out without you guys raising rate too much and maybe putting the economy into a recession. Thank you.
Yeah. So our job is to get inflation back down to 2%. We have to take the supply side as given, right? Because our tools don't work on the supply side. So what we're doing is raising interest rates to get demand into better balance with supply. Can supply move over time? Yes, and that's what makes the assessment as we go forward more challenging, right? Because it's not just demand moving. Supply will move in one way or another. As I said, there are some positives perhaps of supply. Maybe the supply chain disruptions will abate a little quicker than we thought earlier they would, and that'll be a positive. But we can't rely on that. We have to do what we can do with our tools to get inflation back down to 2%, and we will do that, right? We are resolute in doing that. I think the locution, transitory was the wrong locution. I've said that publicly, early on. I think the intention was to try to distinguish things happening on the demand side of the economy from what was happening on the supply side, because you're exactly right. Some of the inflation is driven by what's happening on the supply side of the economy. But right now, right, we are focused on doing what we can do to get inflation back down. And it will be painful, right? We are going to see slowing on the demand side of the economy. That means slower growth, it means slower employment growth, and it means the unemployment rate is going to move up. But we have to do that. If we don't do it now, right, the cost on the economy is going to be much greater later. And so that's why it's imperative that we do this. As I said, I don't have in my forecast right now a recession. I do have growth, well below trend over the next couple of years. But even if the economy were to go into recession, we have to get inflation down.
Okay, if you'll join me in thanking Dr. Mester one more time.